Hello and welcome to our new investment strategy update. Trump 2.0 is turning out very different from market expectations after Trump 1.0. A slowing US economy is the first casualty of US policy uncertainty. Companies are investing less. This is an early effect of the trade war as businesses are faced with tariff unpredictability. Does this mean we see a US recession ahead? Put simply, no. This cycle has not ended, because the US economy has been running on two engines, two types of spending, by companies and by consumers. While businesses are hesitant to invest, consumption trends remain healthy. This is the lion's share of the US economy, and it's still supported by a solid job market and positive real wages. US growth may slow this year to just under 2%, slightly less than its potential, but still away from recession. The Federal Reserve continues to manage the trade-off between downside employment risks against upside inflation risks, mainly from tariffs. We expect 2 cuts in 2025, which would take the Fed's terminal rate to 4% at the end of the year. Meanwhile, Europe is at a tipping point. Geopolitical pressures have catalyzed fiscal ambitions, changing decade-old policies in just weeks. Fiscal plans from Germany and Europe should improve the long-term outlook for the region as they radically break from decades of underinvestment. In the years ahead, this spending should translate into a more profound economic boost for Europe. Potentially, we're at the start of a significant European growth story. But can the region afford it? Absolutely. The EU's debt as a share of GDP is just 2/3 of the level of the US. And even if Germany borrows and spends as much as it's planning, the country will still have the best fiscal fundamentals in the G7. All this comes as Europe's benchmark interest rates are somewhere close to a sweet spot. With this planned fiscal investment, we expect the European Central Bank to make fewer rate cuts, taking its benchmark to 1.75 by year-end. Meanwhile, in China, stock markets recorded gains thanks to the tech sector, and the government's announced new policy targets. But we think it will be difficult for China to defend its 5% official growth target for 2025, as US and other tariff restrictions will hurt exports. So everything is moving fast. How is this environment reshaping the investment outlook? Markets had priced in positive impacts from the new US administration. Now, they are coping with the erratic and unpredictable policy making, and volatility has risen significantly. Macroeconomic conditions, earnings growth, and liquidity are still supportive of risk assets, and we see more upside, notably in stock markets. But to weather short-term uncertainties, we have lowered global equities to neutral levels by reducing our positions in US equities to neutral. European equities have outperformed so far this year, and the euro has reversed much of the weakness against the dollar. The region is emerging as a long-term investment destination thanks to appealing valuations and the promised fiscal spending. This is a fundamental shift that could lead to further rebalancing of global equity portfolios, which in recent years have heavily relied on US returns. For now, we have only started rebalancing our portfolios by reducing our exposure to the US dollar. When it comes to currency markets, we indeed prefer the Swiss franc and the Japanese yen. In fixed income, we hold overall exposures at neutral levels. We are still underweight government bonds, where we like the 5 to 7 year maturities, and where now is a good time to lock in more elevated yields. We also favor the higher yields available from corporate bonds. The world and global economy are undergoing profound shifts, and visibility is poor. We think the best portfolio response is a high degree of portfolio diversification supported by a higher liquidity that allows us to deploy capital as soon as conditions warrant adding risk again. Through unknowns, we remain vigilant. Thank you so much for watching.